Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Back with the man, myth, the legend, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Have a little bit of a cold today, so please bear with me. I've got a little scratchy throat, a little nasally action going on, but doing well otherwise.
There you go. I can tell you your voice is definitely deeper. It's
Yeah.
it's kind of cool, actually.
I got a face for radio and a voice to match.
They, that's funny. That's funny. Hey, what I want to do in this video, we always tackle three topics. I really see these three kind of being, part A, part B, and then, how do we take advantage of? So just to set it up, step one, video one, we're going to talk about some major headwinds. I see some major headwinds in the world for both the economy, the GDP, consumers, all of that. Step two will be, hey, because of these headwinds, what do you think our chances of a 20% drop in asset value in a quick fashion, maybe a month or less, might be? And then finally, close it out on the positive side. Where might the opportunities be? Because there's always opportunities in the chaos. So, Greg, what do you think? Are we facing any major headwinds? And if so, what do you think they might be?
Yeah, there's a lot out there. And, like I always say, bad times never last, good times never last. Things go in peaks and cycles, and it's just the natural order of things in financial markets with assets, things like that. We've been on a QE zero interest rate environment basically since 2008, 2009. And anytime the Fed has tried to deviate from that, the markets throw a fit and we see the negative effects and results of that. So the headwinds that we're facing right now, obviously, are geopolitical conflict, potential conflict out there. That's a big one right now that markets are reacting to, trying to price in some sort of a conflict between Russia and Ukraine, regardless of what people think, whether they will or they won't end up in conflict or a war. Markets are reacting. So markets are pricing that in because markets are always forward looking, markets are always right, and investors are always looking at risk and how to assess risk. And what that means is preservation of capital. I don't want to lose any money. So that's how markets first and foremost think. Number two, you have the possibility of quantitative tightening, the end of the zero interest rate policy regime, and the end of QE. We don't know what that's going to look like because the Fed is still pumping money into the economy as we speak with record inflation.
Crazy.
They haven't done anything to interest rates. So
Yeah.
Nothing's changed other than the way they're talking.
Yeah.
So the headwind, and the market's trying to price in some sort of action. And, and then number three is obviously inflation. It's a global problem. It's not just, the United States. Wages are going up, costs are going up, supply chains constrained. Some of it's going to, ease up. Some of it is temporary, transitory, whatever you want to call it. But the bulk of it is not. It's permanent. It's going to get worse before it gets better. And one of the interesting things that's happening is a lot of companies and manufacturers are realizing, wait a minute, we're way more profitable now by limiting supply because there's so much demand. Why change that? So you're going to see, especially automobile manufacturers, so that's the other thing that we have to potentially keep an eye on in terms of an inflationary environment. And the only way to combat that is to raise interest rates, suck liquidity out of the markets, and reduce demand. That's how you keep prices under control. So a lot of things going on there that we have to look out for and, potentially price in. And the one thing that the markets haven't priced in, a lot of people say, oh, it's baked into the markets, it's priced in. What the markets haven't priced in is longer term effects of everything we just talked about. They're pricing in the immediate knee-jerk reactions, but they can't and haven't priced in long-term effects yet. So that's going to lead into your point number two.
Yeah, I think there's a lot of things, because everybody who studies economics has to have their thing, right? Because there's so many things in the economy, knobs and levers. I've always worried about the consumer, right? Average mom and pop, and when I think about today, just in the last, I don't know, call it 60 days, maybe, there's just a lot more to be concerned about, right? There was, the pandemic shutdown of March 2020 was like no other, right? Nobody saw that coming, at least, nobody that in my circle saw it coming. It was fast, shutting down, the number one world economy. They did it, right, for a couple of months, and then to see it come back, fits and starts, and then we had about a year of, all right, we're kind of getting past this thing, and now we're near the end of it, knock on wood, hopefully. And then we have this Russia, Ukraine, China, Taiwan, just a general world that is not in the same place we all were a couple of years ago, and they're I sometimes people, like Putin or President Xi or whatever his name is, like I think China particularly is suffering, right? I think they've shot themselves in the foot. They reloaded the gun. They shot themselves in the foot again. And sometimes you do geopolitical things to distract the citizens. And it really concerns me that we may have some of that going on right now, and just reasons to be concerned. And then we're on a Fed tightening cycle, which, often leads to a bear market. And, oh, by the way, they've had a $9 trillion balance sheet, and they've talked about reducing it $2 trillion this year. The last time they tried it 25% that size, it didn't end well. See Q4 of 18, right? So I think there's a lot of things that like headline fears. But to your last point, I think there's things behind it that the average person's not thinking about. That's the real boogeyman. I think all this up here is, knock on wood, mainly theater. It's the boogeyman stuff. It's the cost of money. It's the extraction of liquidity that I don't think we're ready for.
Yeah. Markets and assets are repricing right now. And the question is, what are they repricing to? Because like I said, some of this stuff, obviously is what they're attempting to reprice. What they can't reprice is long-term effects. And then the third thing that they absolutely can't anticipate and reprice is everybody thinks the Fed's going to prop the markets up and bail the markets out. Okay. 2020 pandemic was one thing. Okay.
Yes.
You're shutting businesses down. You're shutting the economy down. You have to take action because the economy is no longer humming. Mm-hmm. We still have a pretty strong demand out there. We still have a pretty strong economy overall. I mean, there's more jobs available than there are people willing to take them. Mm-hmm. So, and there's plenty of demand. We're seeing, production numbers, GDP come out, retail sales are up, earnings are up, corporations are doing well, all those types of things that will tell you, from a Fed standpoint, hey, the economy's good, strong, labor market's good and strong. We can't step in, because if we do, it's going to get even worse and get way out of control. So what the markets don't know is, or what they're anticipating is, the Fed is always going to be there to backstop the markets and prop it up. But economy's strong, pandemic's gone, hopefully forever. Hopefully we won't have to, revisit that again.
Yeah.
So they're going to have to let the markets reprice and work themselves out.
I agree.
So I don't think they're going to step back in, and there's definitely no political will for them to do so.
Yeah, I agree with you. I think there's basically a lot of traders, and I'll call them traders, maybe call them investors, who believe in the Fed put, right? That's really, unfortunately, what the Great Recession taught them, right? Basically, if they pile on enough risk and debt, there's no downside. The Fed just came in and bailed everybody out. Nobody went to jail, or almost nobody went to jail. And I don't know that they can do it this time. I don't think there's the political will.
Yeah, they had the great financial crisis. They had the pandemic. They need a reason in order to keep doing what they're doing. Well, they haven't stopped anything yet, so they're still doing it. So
funny, yeah.
But once they do stop, if they do stop, they're going to need another reason, a big reason to step in, and war could be a big reason. If the world's at war, the country's at war, whatever, that could be a big reason for them to step in.
Sure.
But the biggest thing on the horizon too, that the markets haven't fully priced in yet, is the election cycle. And the biggest narrative is going to be inflation. So there will be no political will to keep pumping up Wall Street when the average American can't afford to buy groceries. And I'm telling you, I don't know if you go to the grocery store. I do all the time, because I'm always driving by it on the way home when I'm in and out doing things. So I'll just stop and I'll pick up whatever we need for the day, because that's just kind of how it works. I keep staples on hand, but I like to go every day and keep it fresh. Prices are crazy, man. It's every time you go to the store now, it's $50 or $100 when it used to be $20 or $50. Gas is, in my area, it's probably worse than yours. $3.50, $3.60 a gallon. We're used to seeing under $2. It's hitting people everywhere, and people are starting to get mad about it and are starting to speak out about it. So that's what politicians are paying attention to, not Wall Street.
Yeah, I agree with that 1,000%. This is right. We have had 40 years of declining rates and a relatively benign inflation with a couple of little hiccups. It's here. It's real. It's hitting everyone. And frankly, it's still getting worse. The data is set up to get worse until April, right? You do that into an election cycle that really starts then. I know the election's November, but Inflation is it is a boogeyman. It hurts most people.
Yeah,
And
it's fascinating. This is the most complicated puzzle the Fed has ever faced in the history of the Federal Reserve. So it'll be interesting to see how they continue to navigate, if they actually do anything, because again, they haven't done anything yet. They're just talking about it. So we've got some interesting times ahead, that's for sure.
yeah, as we kind of wrap up episode 1, I believe the Fed has waited too long and they only have 2 bad outcomes. There is no good outcome at this point. One, they raise rates, they get on this tightening cycle, they take the funds rate from 0 to something over 2 in a relatively quick fashion. That's going to hurt assets and probably hurt some assets more than others. Or they just close their eyes, monkey see, monkey do, or whatever, right? And they just pretend and they just hope and pray. And that hurts, I don't know, 90% of the people. And it hurts them worse and worse and worse. So I don't see any good outcomes. Somebody's getting hurt. And my guess it's going to be the rich. And that's what consumer sentiment said last week, is families with over $100,000 in income a year are particularly nervous, and they probably should be.
Yeah. It's, and from the wealthiest out there in the Wall Street and, investment banks and things, they've all been sent the signal. They've all been able to take their profits off the table. Congress, now all of a sudden the Fed can't invest and Congress can't invest, and, hey, perfect timing, right? So
exactly.
No better way to mark the top than that right there.
That is hilarious. Well, this has been a great conversation. I look forward to rolling into number 2. But before we do, how can people find you?
Yeah, gregdickerson.com. All my social media links are there, YouTube and social media links, gregdickerson.com.
Thanks, buddy.